Hello, everyone. Welcome to today's finance lecture. Today, we are going to study financial statement analysis with a focus on ratios, DuPont analysis, benchmarking, and limitations. Think of financial statements as the medical records of a business. The income statement, balance sheet, and cash flow statement give us raw information. But raw information is not enough. Financial statement analysis helps us turn those numbers into a diagnosis. Our goal is not simply to calculate ratios. Our goal is to understand what the numbers are telling us about the firm. Is the firm profitable? Is it liquid? Is it using its assets efficiently? Is it relying too much on debt? Is it creating value for investors? A single number rarely tells the full story. A ratio becomes useful when we compare it over time, against competitors, against industry averages, against management goals, or against investor expectations. So, in this lecture, we will learn how to read financial statements like analysts. We will organize evidence, ask better questions, and interpret financial performance with judgment. Let's begin with the basic financial questions that financial statements help us answer. First, is the firm profitable? To answer this, we look at sales growth, profit margins, operating income, net income, return on assets, and return on equity. Second, is the firm liquid? Liquidity means the ability to meet short-term obligations. Here we examine cash, receivables, inventory, current liabilities, working capital, and short-term cash flow strength. Third, is the firm using assets efficiently? For this, we look at inventory turnover, receivables turnover, total asset turnover, and fixed asset turnover. Fourth, is the firm relying heavily on debt? We examine debt ratios, debt to equity, equity multiplier, interest coverage, and debt service capacity. Fifth, is the firm creating value for investors? We consider earnings per share, price to earnings ratio, market to book ratio, enterprise value multiples, and stock performance. These questions are connected. A firm can be profitable, but still have cash problems. A firm can have high return on equity because it performs well, or simply because it uses a lot of debt. Good analysis requires structure. We begin with the business model, review the statements, prepare common-size statements, calculate ratios, compare results, interpret causes, and recognize limits. Let's now talk about common-size statements. Common-size statements convert financial statement items into percentages. This makes comparison much easier, especially when firms are different sizes. On a common-size income statement, each item is expressed as a percentage of sales. The formula is simple. Common size income statement item equals the income statement item divided by sales. For example, instead of only saying cost of goods sold is $1.2 million, we might say cost of goods sold is 60% of sales. That immediately tells us how much of each sales dollar is used to cover the cost of goods sold. On a common size balance sheet, each item is expressed as a percentage of total assets. The formula is common size balance sheet item equals the balance sheet item divided by total assets. This helps us ask useful questions. What percentage of assets is tied up in inventory? How much is in receivables? How much of the firm is financed by liabilities? How much is financed by owner's equity? Common size analysis separates size from structure. A large company and a small company may have very different dollar amounts, but their cost structure, asset structure, or financing structure may be surprisingly similar. Let's continue with trend analysis. Trend analysis compares financial data across multiple periods. It helps us see whether a firm is improving, weakening, or changing direction. A simple growth rate is calculated as current period value minus prior period value divided by prior period value. We can apply trend analysis to sales, gross margin, operating margin, net income, cash flow, debt, inventory, receivables, and capital expenditures. But the most important idea is this: related trends should be compared together. Suppose sales increase by 8%, but accounts receivable increase by 30%. At first, the sales growth looks good, but the receivables growth may suggest that the firm is selling more on credit, collecting cash more slowly, or experiencing customer payment problems. Now suppose sales increase by 5%, but inventory increases by 25%. That could mean the firm is preparing for future growth, but it could also mean inventory is not selling. So, trend analysis is not just about calculating growth rates, it is about noticing relationships. Are sales growing with cash? Are profits growing with assets? Is debt growing faster than earnings? Trends help us move from static analysis to dynamic analysis. We are no longer asking only, where is the firm today? We are also asking, where is the firm going? Now we move to ratio analysis. Ratio analysis compares one financial statement item with another. Ratios make financial information easier to interpret by scaling numbers relative to sales, assets, liabilities, equity, earnings, or market value. Ratios are commonly grouped into 5 major categories: liquidity, profitability, asset management, leverage, and market value. Let's begin with liquidity ratios. Liquidity ratios evaluate whether the firm can meet short-term obligations. They focus on current assets, current liabilities, cash, receivables, inventory, and near-term operating cash flow. The current ratio equals current assets divided by current liabilities. It measures broad short-term coverage. The quick ratio equals cash plus marketable securities plus accounts receivable divided by current liabilities. It is more conservative because it excludes inventory. The cash ratio equals cash plus marketable securities divided by current liabilities. This is the most conservative of the three because it focuses only on the most liquid assets. But be careful. A high current ratio does not always mean strong liquidity. Receivables matter only if customers pay. Inventory matters only if it can be sold without large discounts. Very low liquidity may signal difficulty paying bills. Moderate liquidity may show balance. Very high liquidity may show safety, but it may also suggest idle cash or excess inventory. Next, let's examine profitability ratios. Profitability ratios measure the firm's ability to generate earnings relative to sales, assets, and equity. We begin with margin ratios. Gross profit margin equals sales minus cost of goods sold divided by sales. It tells us how much of each sales dollar remains after covering the direct cost of products or services. Operating profit margin equals operating income divided by sales. It can also be expressed as EBIT divided by sales. This ratio includes operating expenses, so it tells us more about core operating performance. Net profit margin equals net income divided by sales. This is the bottom line margin. It includes interest, taxes, and non-operating items. Profitability can also be measured relative to resources invested in the business. Return on assets equals net income divided by total assets. It measures profit relative to the asset base. Return on equity equals net income divided by shareholders' equity. It measures profit relative to owner's investment. But ROE must be interpreted carefully. A firm can increase ROE by using more debt, because debt reduces the amount of equity financing relative to assets. That may increase returns, but it also increases risk. In practice, analysts often use average total assets and average equity because the income statement covers a period while the balance sheet shows a point in time. Let's now discuss asset management and efficiency ratios. Asset management ratios measure how efficiently the firm uses assets to generate sales. This is very important because growth usually requires investment. Firms may need more receivables, more inventory, more equipment, more technology, more buildings, or more operating capacity. Inventory turnover equals cost of goods sold divided by inventory. It measures how quickly inventory is sold and replaced. Days sales in inventory equals 365 divided by inventory turnover. This converts inventory turnover into days, which is often easier to understand. Receivables turnover equals sales divided by accounts receivable. It measures how quickly credit sales are converted into cash. Days sales outstanding equals 365 divided by receivables turnover. This estimates the average number of days it takes to collect receivables. Total asset turnover equals sales divided by total assets. It shows how many dollars of sales are generated for each dollar of assets. Interpretation depends heavily on the business model. High inventory turnover may mean efficiency, but it may also mean inventory shortages. Low inventory turnover may mean weak demand, obsolete inventory, or a deliberate decision to carry more stock. Retailers, manufacturers, software firms, airlines, restaurants, and banks use assets very differently. So, efficiency ratios must be interpreted in context. Let's now move to leverage ratios and market value ratios. Leverage ratios evaluate how much the firm relies on debt and how well it can meet financial obligations. Debt can increase returns to equity holders when business performance is strong. But debt also increases financial risk because interest and principal payments must be made even when performance weakens. The debt ratio equals total liabilities divided by total assets. It tells us what proportion of assets is financed by liabilities. The debt-to-equity ratio equals total liabilities divided by shareholders' equity. It compares creditor financing with owner financing. The equity multiplier equals total assets divided by shareholders' equity. It shows how much of the asset base is supported by each dollar of equity. Times interest earned equals EBIT divided by interest expense. It measures how many times operating income covers interest expense. Now, market value ratios connect accounting performance to investor expectations. Earnings per share equals net income available to common shareholders divided by shares outstanding. The price to earnings ratio equals market price per share divided by earnings per share. Market to book ratio equals market value of equity divided by book value of equity. Enterprise value equals market value of equity plus debt minus cash, and EV to EBITDA compares enterprise value with operating earnings before interest, taxes, depreciation, and amortization. Market ratios tell us not only about current performance, but also about expectations. Now we come to one of the most useful frameworks in financial statement analysis, DuPont analysis. DuPont analysis decomposes return on equity into its main drivers. Instead of treating ROE as one number, DuPont analysis asks, why is ROE high or low? The basic idea begins with this formula. Return on equity equals net income divided by equity. Then we break ROE into three parts. ROE equals net profit margin times total asset turnover times equity multiplier. Net profit margin measures profit per dollar of sales. It reflects pricing power, cost control, taxes, interest burden, and operating efficiency. Total asset turnover measures sales per dollar of assets. It reflects asset utilization, capital intensity, inventory management, and receivables management. Equity multiplier measures assets per dollar of equity. It reflects debt financing and financial leverage. This is powerful because two firms can have the same ROE for very different reasons. One firm may have high margins and low leverage. Another firm may have low margins, faster asset turnover, and high leverage. The ROE may be the same, but the risk profile is not the same. DuPont analysis turns ROE from a single number into a conversation about business model, operating performance, asset intensity, and financial risk. Before we finish, let's talk about benchmarking and the limits of ratio analysis. Benchmarking means comparing a firm's ratios with peers, competitors, industry averages, or management targets. This is essential because financial performance depends heavily on industry structure. A grocery store may have low profit margins but high inventory turnover. A software firm may have high gross margins but large spending on product development and sales. Airlines are capital intensive and often use substantial fixed assets and debt. Banks have balance sheets that are very different from industrial firms. So, we should compare firms with similar products, customers, asset intensity, geography, growth stage, and risk exposure. Now, ratios are useful, but they have limitations. Accounting choices can affect ratios. Industry differences matter. Ratios are based on historical data. One-time events can distort results. Seasonality can mislead. Inflation and historical cost accounting can affect comparability. Book values may differ from economic values. Market ratios reflect expectations as well as current performance. A common mistake is calculating too many ratios without a clear question. Another mistake is calling a ratio good or bad without a benchmark. The disciplined analyst uses ratios as evidence, not as automatic conclusions. Thank you for joining me today. I hope this lecture helped you understand how financial statement analysis turns numbers into insight.